So we're 10 years out, we've left 5 trillion of potential growth on the table. That's the output gap where the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. But being objective using the numbers, I mentioned we're in a depression, we're going to stay that way. The United States is Japan. You know, Japan had the famous lost decade. Well, the last decade was 20 years ago, started in 1993-2000. Japan's now almost at the end of their third lost decade. If something doesn't change either in terms of policy or a collapse, something gets worse, but absent that we're going to remain in this kind of punk 2% growth as far as the eye can see. You know, people say, well, the headwinds, traffic, technological productivity, psychological, etc. haven't changed, and there's no reason to expect they'll change. So combine this world depression, because what I just described is true of Japan. That's true in Europe, not so true in China, but China is a special case. There's a lot of they cooked the books. There are 78% growth that they've been printing. Cut that in half because 45% of that growth is infrastructure, most of which is wasted. So if you apply generally accepted accounting principles and made them write off all that wasted investment, maybe a lot lower than it appears. But the whole world is caught in this trap. Meanwhile, debt is going up faster than the growth. Is debt good or bad? Well, it depends. Debt can be good if you can afford it. If you can pay it off and you can use it for productive purposes. It's bad if you can't afford it, it's not sustainable. You're using it as a substitute for real growth and it's all gonna crash and burn. So you can't understand debt in isolation. You have to understand debt relative to income and that debt to GDP right ratio, which is something I spend a lot of time looking at. The GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse. It looks like we're heading for a global debt crisis. Not quite there yet, but it could happen sooner than later. Very little doubt that the Fed is going to tighten in. Based on scenario for the Fed is straightforward. They're going to tighten 4 times a year every March, June, September and December. Unless one of 3 pause factors applies. The pause factors are disorderly decline in stock markets. Employment starts to go down, basically lose jobs. Unemployment's going up. The third one, disinflation or deflation, spins out of control right now. None of those 3 pause factors applies. The stock market, they're going sideways but they're not crashing. The Fed doesn't care if the stock market goes down 15% in 6 months. They do care if it goes down 15% in 6 days. That's disorderly. And that's the kind of thing where you would see the Fed pause, but that's not happening right now. Job growth is strong. Inflation is ticking up. I don't think it will spin out of control, but we're out of that disinflation danger zone. So none of the 3 pause factors applies. Therefore, you should expect the Fed to just keep raising. But there's no doubt that the Fed is over-tightening because in addition to trying to get interest rates back to normal, they're also reducing the balance sheet. They're trying to normalize the balance sheet. But now the Fed has a dilemma, which is what are they going to do if the US economy goes into a recession? As I said, we're in the 10th year of an expansion. You know, the old cliché expansions don't die of old age is true, but they do die. And history shows that it takes about 4% points of cuts, 400 basis points. In other words, for the Fed to get the economy out of recession. Well, how do you cut interest rates? 4%? The answer is you can't. You cut them to 0 and then you're stuck. You're at the zero bound and the evidence is good that negative rates don't work. So then what do? We're gonna put some money again. Modern monetary theorists would say, yes, I disagree, and I think the Fed disagrees as shown by their own actions in trying to reduce the balance sheet. So what the Fed is doing, they're trying to raise rates, get the balance sheet down maybe 2 trillion, a little bit less. So that when the recession hits, they can run the playbook again, they can cut rates and if necessary, to QE. But here's the dilemma. Can you normalize interest rates and normalize the balance sheet without causing the recession that you're preparing to cure? That's the conundrum. I think the answer is no. I think that actually in trying to tighten to get ready for the next recession we're going to cause the recession. There's no data, there's no time series that tells you how this is going to play out, except during QE, what did we see? Did not see a lot of inflation, but we saw asset prices blow up, stocks, real estate, you know, other asset categories, they all went up a lot. So it seems at least kind of first order intuitive that if you print money, asset prices go up, if you destroy money, asset prices are going to go down. So what the Fed is doing, they're destroying money. We do see in the money supply. So they really do double tightening. In addition to the 4 rate hikes a year, this reduction in the balance sheet is probably equivalent, an estimate, probably equivalent to 4 more rate hikes per year. So they're actually tightening, probably going to throw the economy into recession. The Fed has never forecast a recession. They have a terrible forecasting record. This will happen before they know it. Of course, we all know that stocks will go down. So based on that, I'm not bullish on growth, on bearish on stocks. People say, well, gold hasn't gone up a lot. It's true. I'm surprised it hasn't gone down more or given the tightening environment that we've described. So gold has actually performed fairly well given the environment. Now, what I do expect is in time as this signs of recession emerge. Yield curve inverts, growth slows, job creation slows down, not the full-scale recession or crash, but just enough warning signs, and the Fed reverses course all of a sudden. They do pause at one of these meetings. Gold's going to skyrocket because that's an admission. At that point, the Fed's throwing in the towel and say, you know what, we really can't escape the room. We can't get back to normal because when we try, we sink the economy and we have to back off, and that's when gold will shine. No pun intended, because it will be very clear that the Fed cannot get out of this easy money mode. One thing I never do, I never make a forecast or make a claim without backing it up. There are people out there, they're a dime a dozen. You know, this is going to crash, or this is going to go up, or growth is great, or so. Whatever, that's fine. But you need to back that up with some kind of analytics, some kind of data, some kind of analysis that you can do. And I always do that, and I'm always happy to kind of drill down on that. So the methodology I use is quite different from what Wall Street forecasters use. First of all, just spend a minute on what Wall Street does and what most analysts do, because it's badly flawed. It's no surprise that, you know, every year, the Fed does a 1-year forward forecast. So, in 2009, they predict 2010, they predict 2011. So on same thing for the IMF, same thing for Wall Street, they are off by orders of magnitude, year after year. I mean, how can you be wrong by a lot 8 years in a row and then have any credibility? And again, the same thing with Wall Street, you know, you see these charts, the charters show the actual path of interest rates or the actual path of growth. And then along the timeline, which is the x-axis, will show what people were predicting at various times. The prediction is always way off the actual path. And there's actually good social science research that shows that economists do worse than trained monkeys in terms of forecasting. And I don't say that in a disparaging way. Here's the science: a monkey knows nothing, right? So if you have a binary outcome, up, down, high, low growth, recession, and you ask a monkey, they're going to be right half the time and wrong half the time because they don't know what they're doing. So you're going to get a random outcome. Economists are actually wrong more than half the time for 2 reasons. 1, their models are flawed. Number 2, what's called herding or group behavior. And economists would rather be wrong in the pack than go out on a limb and maybe be right. But if it turns out you're not right, you're exposed. There are institutional constraints. People want to protect their jobs, they're worried about other things and getting it right. So the forecasting America is pretty bad reasons for that. They use equilibrium models. Capital markets are not an equilibrium system. So forget your equilibrium model. They use the efficient market hypothesis, which is all the information is out there. You can't beat the market. Markets are not efficient. We know that they use stress tests which are flawed because they're based on the past. But we're always outside the past. The future could be extremely different. The next crisis is worse. There's nothing in that history that's going to tell you how bad it can get. And so they assume prices move continuously and smoothly. So price can go from here to here or from here to here. But as a trader, you can get out anywhere in between. And that's where all these follow insurance models and stop losses come from. That's not how markets behave. They go like this. They just gap up. They don't hit those in between points where they gap down your way underwater, or you missed the profit opportunity before you even knew it. So, in other words, the actual behavior of markets is completely at odds with all the models that they use. So it's no surprise that forecasting is wrong. So we talked earlier about business cycles, recessions, depressions. And that's conventional economic analysis. That's really thinking in terms of growth, trend growth, below trend growth, business cycles, etc. collapse, or financial panic is something different. A financial panic is not the same as a recession or a turn in the business side. They can go together, but they don't have to. So let's talk about financial panics as a separate category. Complexity theory shows that the worst thing that can happen in a system is an exponential function of scale. Scale is just how big is it. Now, you have to talk about your scaling metrics. We're talking about the gross notional value of derivatives. We're talking about average daily volume on the stock market. We're talking about, debt. We could be talking about all those things. This is new science. So I think it would be years of empirical to make this more precise, but the theory is good and you can apply it in a sort of rough and ready way. In other words, if you triple the system, the growth went up by a factor of 10, 50, etc. There's some exponential function associated with that. So people think, well, gee, in 2008, we learned our lesson, we got debt under control, we've got this under control. No, debt is much higher. Debt to GDP ratios are much worse. Total notional value, gross social value is much higher.